Welcome to TreasuryONE's monthly currency analysis and forecast video for the month of September 2020. My name is Andrew Kinsey. I want to start with a number of domestic and international factors that deserve our attention this month. I want to lead off with South African public finances, followed by Eskom, the poster child that we love to hate, inflation and the progress of central bank quantitative easing, what's the status of the global risk on trade, what the future holds for dollar index, since we seem to have stabilized around 93 at the moment, and what do we think for oil after it seemingly has topped out in the mid $40 range. South African public finances are rapidly reaching the point of no return, and in my opinion, we've already reached there. We're out of time and out of money. We're the only people who are asking why we're continuously spending money that we don't have on goods and services that we don't need. I'll tell you one thing that we don't need is additional public sector salaries, which are expected to breach 600 billion rand this next year. Talking about goods and services that we do need, Eskom, which is strategically critical to South Africa's future prosperity, is on record as always promising a lot, but has delivered very little. There are two constant themes that I absolutely detest about Eskom. Firstly is the continued amount of money that they ask for, as well as the offering of perpetual excuses as to why they can't do what they're mandated to do. Despite massive inflation of central bank balance sheets, actual inflation doesn't seem to have bled through to the real economy. It's present, of course, in the equity and other asset markets, but that's not what the central banks are selling to the real economy. Why are they trying to pump up inflation in any case? Surely low inflation is a good thing. Well, given the fact that countries, companies, and individuals have indebted themselves to the eyeballs over the last 2 to 3 decades, policymakers and central bankers alike are absolutely terrified that the global economy falls into a deflationary trap and thereby swamps those who owe the most money. And guess who owes the most money? Central government. The global risk on trade, which has been in place since the March and April lows, seems to be intact, if only by its fingertips. The hiccup that we saw last week in US mega cap stocks really raised the fears that we'd run ahead of ourselves. There's no doubt that valuations are very, very rich at the present time, but that doesn't mean that we stop here. The 1999-2000 tech bubble went on much further and much longer than people ever believed. This case may be exactly the same. Turning to the dollar, it seems to have stabilized around about the 93 level after having topped at about 104 in the midst of the crisis in March and April. In order to convince us that we need that we're actually going to turn higher for the rest of the year, we need a sharp move and relatively soon. Take 94 out of play before heading higher. Of course, where the dollar goes, that'll have a dramatic impact on what the rand will be doing over the period to the end of the year. As far as oil is concerned, we believe that we topped out in the mid $40 range for Brent and West Texas Intermediate. Does that mean that we're heading much lower and challenging the lows of April? Well, perhaps not that far, but we definitely think that West Texas is going to head into the high 20s. There's just not enough industrial and retail demand around to convince us that higher prices are justified in any way. Here's a little more detail on South African central government budgets and finances. As you can see, the numbers are becoming rapidly higher and higher. Tax revenue is expected to top out at about 1.6 trillion in 2022-2023. At the same time, total government expenditure is expected to be round about 1.9 to 2 trillion rand. Given the hammer blow to the economy over the last 9 months, we should expect that tax revenue is going to be under severe strain. But at the same time, government seems to think that additional spending is warranted. If looking at all these numbers are just too much for you and you feel like having a vomit, Just have a look at the chart that I have constructed for you that compares tax revenue, debt servicing, and public sector salaries. I've used 2003, 2004 as the index year. What stands out immediately is the rapid increase in public sector salaries. It's consuming an ever greater proportion of total revenue. Debt service costs seem relatively benign, but remember that 2 decades ago, interest rates were far higher. So we're still increasing debt servicing costs, albeit at lower interest rates. We're not handing out any prizes for guessing what is going higher faster, revenues or public sector salaries. The ANC just doesn't have the wherewithal to put a cap on it. Just to give you a last bit of detail here, debt service costs and public service employee costs are now 45% of the total budget. The idea behind national government is it's supposed to provide goods and services that the private sector cannot or will not provide. But we spend money on unproductive and incompetent public services and borrow money to live beyond our means. Definitely something is not right. Again, we've run out of time and run out of money, good people. The next 3 slides deal with 3 different capital markets which offer contrasting opinions about the state of South African finances and the view that the international community have of us. The first instrument is a Rand basis swap. This is a tool that banks use to be able to switch from Rand funding into US dollar funding. Very simply, the more negative the swap number, the more difficult funding conditions are. In the midst of the market chaos in March and April, rates went very negative, and I've pointed out a -30 there for you. As the markets and economy have recovered since, bank funding pressures have abated considerably. This constitutes a small vote of confidence for the South African banking system. To put a hard number in it, banks can get funding in the 1 year 70 basis points cheaper now than in April. By contrast to the relatively positive picture painted by the basis swap market, the Dollarrand currency option market is still heavily biased towards Rand weakness across all maturities to 1 year. How do we interpret this chart? Well, in the top right-hand quadrant, I've got Rand depreciation options, if you like. These are expensive. The Rand appreciation options in the bottom left-hand quadrant are considerably cheaper. We do have a number of structures that are available to exporters who are in a position to be able to take advantage of this bias. They can sell the expensive options and buy the cheap options. On to South African credit default swaps. South Africa's credit worthiness has clearly suffered very negatively over the last year, to the point that the market says that there is now a 16% likelihood that we will default over the next 5 years. That's up to 75% in 1 year. As the chart makes evident, the Rand is at a very interesting juncture right now. Since all-time highs were recorded just above 19 in April, the Rand has pulled back significantly to trade within never tighter ranges between 16.5 and 17.30. These lower levels have been consistent with broad dollar weakness and stronger European currencies, as the following slides will show. Although the Rand found solid support at 16.5 over the last couple of months, it broke lower on the 15th of September. We think that any extension of this move lower is dependent on externalities, such as whether a global risk-on trade is maintained and extended. The financial press are cheerleading a further move higher in the euro, but they're always late in the day. It's already a crowded trade from our perspective. From a technical standpoint, it's possible to count a completed 3-wave ABC move structure, including the wide-ranging moves in March. If the euro holds significantly below 119.60, then our view that the next large move in euro will be down will remain in place. A higher euro, by contrast, would be consistent with an extension of the Rand to lower levels against the US dollar as tourist money chases higher yields. A lower dollar index implies dollar flowing out of US assets that are overvalued by considerable amounts into other destinations, which may include for once over the recent months into South African bonds. In order for us to remain bullish on dollar index, 92.50 must hold. We'd also like to see a strong move up that takes 94 out of play over the next couple of days and weeks. There's many an importer that I think will have woken up happy this morning. We broke lower from 16.5 on the 15th of September. A sustained break of this level will give importers a much needed opportunity to cover foreign denominated liabilities. Lower repo rates from the SARB's MPC, together with closely linked money market rates, are going to make forward cover a lot cheaper than has been available for most of this year. And in fact, for a large extent of the last decade or so. This is not the time to second guess things. We urge you, if you need to buy foreign currency, then this is a good time to start accumulating that hedge cover. Late to market exporters, by contrast, are inevitably going to find that the market has slipped away from them with this latest move. We can separate out the two types of exporters. For extremely price-sensitive corporates who trade in competitive markets, we think that covering in the forward market, even at these lower levels, is a must. For those who have a higher risk tolerance, we have suggestible option-related structures that may offer help to those who can sell highly priced dollar call options to fund the purchase of less expensive protective put options.